I'm Greg Hunter. Welcome to USAWatchdog.com, where there's a return visit by the author of this book, Fed Up. It came out earlier this year. Very popular book on Amazon. I think it hit number 22 on Amazon, the author tells me. She is a former advisor to the Federal Reserve, the Dallas Fed, actually, and Richard Fisher. She is Danielle DiMartino Booth, a financial expert. Danielle, thanks for joining us today on USAWatchdog.com.
Great to be here.
I want to talk about the Fed. A lot of Fed news going on. I want to start with Jerome Powell, who the president has, offered up. Who I'm sure will get, confirmed in Congress. He offered him up to be the next head of the Federal Reserve. Is the money policy going to stay the same? Are we still going to have easy money because of Jerome Powell?
I think that the market might have Jerome Powell, they call him Jay, a little bit misread. I don't think he's going to upset the apple cart right now. I certainly think that we can expect a continuation of the Fed policy unless the economic data take a dramatic turn for the worse. But I do not think that Jay Powell is a Yellen clone. So when you say easy money, I don't necessarily immediately, Jay Powell's name does not immediately jump to mind when you say the words easy money.
Oh, I didn't know that. That's a little piece of news I didn't know about. We do have, you wrote in 2015 about the abundance of debt. You worked for Richard Fisher, who came out in, I think, 16 and said we injected heroin and cocaine. His words, injected heroin and cocaine into the markets. You must have had discussions about how much debt is out there. Abundance of debt. We must have more debt. Now, you and Richard Fisher talk. Are you guys amazed at how long this debt bubble has gone on for? Or even do you think it's a debt bubble? Are you amazed how long this has gone on?
We certainly are, and I'll bring Jay Powell back into the discussion, and Richard Fisher is a big advocate of Jay's. Jay now regrets having voted for QE3 because QE3 is really what got the engine roaring on what we call re-leveraging. There's this misconception in the markets that we've gone through some period where all this debt was pulled off of the market. Look, that's just flat out wrong. Between 2007 and today, worldwide, global credit markets have grown from $170 trillion to $220 trillion and counting. So yes, you can go ahead and use the word bubble all you want because that's what we've got on our hands.
Is there any getting rid of this bubble without lots of pain? I mean, I just heard one of the Fed presidents, along with Maria Bartiromo, saying we're definitely having a rate increase in December, and can the economy take that? What's going to happen if they do it?
Well, I think the economy and the markets both have priced in the 25%, the quarter of a percentage point hike on December the 13th. There's a 90-some-odd percentage probability that that's going to happen. And I think that we'll be okay with short end rates being at 1.5%. It's almost ridiculous to be discussing this. But the fact is there's been so much debt that's built up. There's not much more, I think, that these credit markets can handle in terms of a tighter rate environment. The other missing piece is that the Fed is committed to decreasing the size of its balance sheet, which is in and of itself its own form of tightening as 2018 gets underway and progresses.
Won't that flatten the yield curve? My friend Gregor Manarino says, they're going to flatten the yield curve. I mean, the 10 years at, 2.4, the 30 years at 2.8 or 9. You're going to raise the other end, the short end of the curve, and things going to flatten. Doesn't that signal recession? Aren't they worried about flattening the yield curve, which will touch off a recession?
Well, it's interesting. I look back at some very old testimony from Ben Bernanke from back in 2007 when the yield curve was flattening, and he was saying, no, don't worry, this won't cause a recession at all. Well, another Fed president a few days ago came out and said, don't worry about that flattening yield curve. It will not cause a recession. Well, guess what? Every time we've had a yield curve flatten and actually invert, wherein short-term rates are higher than long-term rates, lo and behold, we have had a recession. So this is definitely something that policymakers need to keep their eye on.
Do you think we're going to have a recession? Do you think we're headed for a recession?
Look, do I think that the business cycle has been suspended indefinitely? No. This is the third longest expansion in the history of the United States, and I think that we are due for a recession. That's just part and parcel of a capitalist society.
What do you think the Fed's biggest fear is? I mean, they won't let this thing correct a percent or two. They're fearful. What is the Fed's biggest fear?
Well, the Fed's biggest fear is that they know darn well that this much credit has built up in the background and that the ramifications for the unwind of what's happened since the great financial crisis is even greater than what happened in '08 and '09, and it's global, and it's pretty viral. So the Fed has good reason to be fearful of what's going to happen when the baby boomer generation and the pension funds in this country take a third body blow since 2000. That's why they're so very, very, very intimidated by the financial markets, by the stock market, so fearful of a correction.
Do they feel like they're forced to raise rates? My friend Greg Manarino, I had a long conversation. He says, ask her this. Ask her if they think they're forced to raise rates for credibility. They know damn well his words. They know darn well the economy is not going that great, and they're raising rates into an economy that's not going great. Do they ask her if they have to do this because they're basically in a tight spot? They have to raise rates for credibility's sake.
Well, look, they missed the window. They missed the window years ago when there were other people on the inside, like Richard Fisher, like me when I was advising him, that were saying this is when your opportunity is in your hands. What they're most fearful of is the fact that even if they raise rates in December, which is fully priced in, that they'll still only have technically 6 bullets in their chamber to reduce rates back down to the zero bound, which I hope they do not do. Are they fearful? Yes. Do I really sit around at night and worry about the Fed upholding its credibility? I think that their credibility has long since been dashed.
What do you think about people like, and this has come out in the last several months, Gunlock, very negative stuff about the bond market. Greenspan says he fears a rapid rate rise. I think that was the same thing that Bill Gross, who used to run PIMCO, the bond king, talking about that the bond market will go supernova. We're getting some big warnings from some heavy hitter people. Are they justified in warning?
Look, I think that they're justified in noticing how very stretched this rubber band is right now. I'm always fearful of bond traders talking their book, and I wonder what their positions are. And I find it very, almost disingenuous that Greenspan is concerned about blowing this magnificent bubble because everything that Bernanke and Yellen learned was at the feet of Greenspan. And he was the ultimate bubble blower himself. But the fact that they recognize how overstretched, again, this rubber band is simply opening their eyes to reality.
Is this why Bill Gross, you think, said that the market is at a top right now? He said you liken it to like an old age retirement community.
Look, the market, unfortunately, has been at a top. If you're just looking at valuations, the stock market's more overvalued than it's been at any time since 2000. Deutsche Bank did a seminal report recently. I'm not quite sure how it even managed to get out the door because it was so honest, that said that the bond market going back to 1800 has never been this overvalued. There's a similar situation going on in Europe where negative interest rates make their bond market even more overvalued. Look, they're just recognizing that we're at a top, but we've been at a top, and that is the prickly nature of bubbles, and that they keep inflating for longer than most people can anticipate, putting a lot of people who are skeptical in the doghouse.
What does it look like when, it's not an if the bubble's going to blow, it's just a when.
Right.
What does it look like when this bond market pops? Just describe it for the man on the street, please.
It's really anybody's guess. That the thing that concerns me the most is that people are not prepared for the principal losses in their bond funds. These are the portions of their 401ks and IRAs that help them sleep at night, and they don't recognize that it's not just a matter of the income that their bonds throw off, but how much they can lose, just like when a stock price crashes, when bond prices are as overextended as they are right now. We've gotten a flavor for what's going to happen just by looking at what's happened to high yield bonds in the past few weeks and how quickly their value has been eroded. And I am most concerned, most concerned for those people who are near retirement who do not realize how much is at risk in their portfolios.
Could we have a credit freeze? In the Fed worried about a repeat of what happened in '08? You have people like John Malden and Malden Economics saying we're going to be very surprised about how little liquidity is in the market. I got a friend of mine that's a micro banker to people that buys equipment from him, and he says nobody has any money. I said, how's it going since '08? Nobody has any money. They got cash flow. They don't have any money. Is that going to be part of it when the thing blows, that everything's going to freeze up?
Well, I think that that's certainly going to be a major component. You know, if you add up what the Federal Reserve is saying it's going to reduce its balance sheet by this time next year, plus the tapering that Mario Draghi at the European Central Bank has promised. You get to $800 billion less in terms of liquidity that central banks worldwide are injecting into the markets. It's a big, big dollar figure. And what Malden is most concerned about, and he's certainly echoing some of the things that I've written about recently, is a freeze up in the capital markets that since 2010 have been wide open, allowing all manner of issuers to access excess liquidity, keep having one more day to stay alive as a company based on a debt lifeline.
So you're telling me that companies are just staying alive by borrowing money?
Imagine that. It's happened before. Zombie companies.
And the only reason why they're making payroll and they're paying the lights and they're paying their taxes and they're making products and they're evidently they're losing money or breaking even is because they have credit lines available?
That's certainly been the case for a lot of the energy companies, the telecommunications sector, the retail sector, a lot of the companies that you say, I just don't know how they're still in business. Well, you can fill in the blank with the fact that the credit markets have remained open even for the weakest borrowers. So what Malden's concern is, what my concern is, what Gross's concern and Gunlock's is that when liquidity is in its abundance, nobody thinks about it. But it doesn't take very long for it to freeze up and go away. That's what happened in '09, and that is certainly what could happen in today's credit markets. Don't even get me started on the fact that Dodd-Frank and the regulations that were put in place after the financial crisis have made liquidity all that more acute in its absence the next time these credit markets turn.
If the credit it gets frozen up, are we going to see an Armageddon of businesses going under?
Well, I think that that's really going to depend on how much collateral damage we see in the banks. The big banks are not necessarily as exposed as they once were. But one of the areas that small and mid-sized American lenders especially have become overexposed to is the commercial real estate market. And I think that if you see distress in that particular area of the banking system, that's going to have a contagion effect to other areas of the credit market and make it very hard for companies to stay in business and keep that operating cash flow, as you just described, going.
So let's just future cast here and say we got a credit crisis. The bubble breaks. Businesses start going under. Unemployment starts spiking. Interest rates start spiking. There are runs on banks. What's the Fed going to do?
Well, I think that they'll come riding in with the cavalry. It's interesting that, again, Dodd-Frank took away the Fed's emergency measures, emergency ability to come to the rescue, but I don't have any doubt in my mind that the credit markets will be given relief by Congress in a heartbeat. There's nothing that scares a politician more than a credit freeze. Not that they could probably define what a credit freeze is, but they can certainly define what you just said, and that's unemployment rising and their constituents' businesses going out of business. You know, it took a deep dive into the restaurant industry, which has been the largest employer, the largest source of employment in the current recovery. And that happens to be one of the least appreciated yet most vulnerable sectors as we turn the corner and head into the next downturn, again, tied to the largest number of jobs that have been created in the current recovery.
And when you say they're exposed how? How are they exposed?
Well, believe it or not, investment bankers encouraged restaurants to overdevelop. And we've had restaurants grow at literally twice the rate of the U.S. population since the year 2000. Some of the carnage that we've seen in brick and mortars is going to be echoed in the restaurant industry. And again, I think it's something that too few investors are paying attention to, despite the fact that they're very low-paying jobs.
And the Fed, why won't the Fed let the market correct a couple of percent? I mean, obviously, every expert I talk to, nobody says, oh, no, we have honest markets. Everybody knows we have dishonest markets. There's not an honest market out there. LIBOR, Forex, futures, stocks, you name it. There's not an honest market out there. Why will the powers that be, the Fed, the central banks, the Exchange Stabilization Fund, pick it? Why won't they? What are they afraid of a 2% correction? They won't let one happen. Why?
Look back to last year when Deutsche Bank took the markets to DEFCON 1. Maybe you were paying attention, maybe you weren't, but it certainly got the German government's attention. And they said, you know what, the checkbook's open. We'll do whatever we need to do because we can't quantify the effect of a major bank hitting a distressed situation. I think what central bankers worldwide fear is that there's been such a magnificent reblowing of the credit bubble since 2007-8 that they can't tell you where the contagion's going to be. So they have this great fear that 2 or 3% or 5% or 10%, they don't know what the daisy chain is going to look like and where the contagion is going to land, whether it's going to be the Chinese bond market, whether it's going to be Italian insolvent banks, whether it might be Deutsche Bank, whether it might be small and mid-sized U.S. commercial bank lenders. They can't tell you where the systemic risk, as they call it, lies, and that's where their fear is. But again, this credit bubble is of their making.
I went to school with my friend Greg Manarino. He says they have no models, and what you're telling me is they have no models. They are driving down the highway like Stevie Wonder.
Yes, indeed.
I mean, they have no idea what's going to happen. Is that what you're telling me?
I don't think any of us have an idea of what the implications are for a $50 trillion debt build since the great financial crisis. It's impossible to say. We've never dealt with anything of this magnitude. You know, one of my greatest fears these days, and people think I'm crazy, is that the investment grade corporate bond market here in the United States has been one of the largest areas of growth that we've seen, and people have piled into it simply because credit rating agencies give these companies the investment grade stamp of approval, and it bothers me in my gut because that's exactly what got us into the subprime situation in the first place.
That to me is just an amazing statement by somebody who understands global financial markets and the Federal Reserve, that they have no idea what's going to happen.
I don't think anybody can tell you. I don't think, look, and I don't think there's also necessarily any kind of coincidence that we're seeing a complete and total changing of the guard. The New York Fed's Bill Dudley announced his retirement, early retirement, shortly after Janet Yellen was not given the nod to be the next Fed chair and Jay Powell was announced as her successor. And I think that they're trying to get out while the getting is good and leave this to the next generation of central bankers to clean up.
Ooh, that's one heck of a statement. They say they don't know what's going to happen, nothing good's going to happen. There is, I always say this, what could go wrong? But in this scenario where they don't know, they don't have a model, they don't know what's going to go on, all the scenarios are all variations, are all shades of black to gray, right? They're all bad.
I can't say they're all good. Look, we've had some serious backstops to the global economy since the financial crisis broke. China really didn't fall into the abyss, which means that neither did Australia, which is in its longest expansion ever. It's in its 26th year. Its household credit is beyond where it's ever been. The same situation with Canada. Europe is also still a mess, even though we're obviously still, right now, Europe looks good because Mario Draghi at the ECB has been throwing so much money at the bond market. But if you can imagine, when the Fed was executing quantitative easing, we were never, ever, as a central bank, buying more than what the U.S. government was issuing in treasuries. Mario Draghi, on the other hand, has bought 7 times issuance since he launched quantitative easing. Without these backstops, it's simply impossible to say on a global basis. And again, our credit markets, our stock markets, our financial exchange markets, they are all interconnected, whether we like it or not. And there's no one model out there that can tell you what's going to happen with so many tried and true backstops in a very weakened position this time around.
Is this why Bitcoin and cryptocurrencies at Bitcoin, $8,000 a unit? There's no coin there. 8,000. People are freaking out. They're looking for something. We just had a Da Vinci painting. Of course, that could be money laundering too. As people wrote me and said it could be, but they're packing $450 million into a painting.
It's to me, Bitcoin is a reflection of panic. It's a reflection of people trying to get money into a safe place, knowing that the governments, the major governments, the developed world have got their printing presses running 24/7. It is a reflection of anxiety in fiat currencies and the fact that it's not practicable to go back to a gold standard. Now, what scares me when you bring up the whole idea of Bitcoin is that the central bankers of the world are studying it very closely to figure out exactly how precisely the blockchain works, so that if and when the time comes, they can march in and do an outright monetization of the debt, buy the debt directly from the U.S. government, and tell us that if we have a $100 bill in our pocket, that's a big no-no, and that from henceforth they're going to be controlling our spending using blockchain technology that's being perfected right now in the cryptocurrency universe.
What about gold and silver? Is that the nemesis of central banks? And why hasn't it gone off? And do you think it will go up? I'm sorry, multiple questions. Gold and silver. No. Why has it not gone up? Do you think it will go up? Sorry.
Look, 2017 is the record year for quantitative easing globally. We have never, not in the darkest days of the financial crisis, central banks have never injected as much money as they have into the markets. Gold reflects that. It is simply a matter of mathematics. When the markets truly believe that Mario Draghi is serious about cutting in half the ECB's purchases, and when they truly believe that central bankers have begun to lose control, and if we see markets correct, especially, I'm no gold bug, but we do know that in times of corrections, that there's no place to hide in traditional asset classes that you can get at your Merrill Lynch brokerage house, and that gold and silver and the precious metals complex are the only places to hide and get true diversification and safety.
And you're saying you're talking about Puerto Rican bonds, or you're talking about something. We're going to dial it right down to. So you got Puerto Rican bonds, and they're worthless, and that's what you're saying is that the bonds are going to get creamed. They're going to be sorry, we're not paying that. Yeah, we can't pay that money. I mean, is that what you're saying? And gold and silver are in your hand, diversified, tangible asset that I own it, I have it, you can't take it away from me.
That's exactly right. And it tends to be the one place, if there's no more of a safe haven perception for the U.S. Treasury bond, then the only thing that's perceived by investors as being safer, as being completely foolproof and Teflon, that's your precious metals complex.
Danielle DiMartino Booth, the author of this book, Fed Up. It's done really well, it's in its fifth printing. Is that right? The fifth printing here?
Yep, it's in its fifth production run. I actually recorded the Audible myself, and those have done even better. So hop on.
Okay, good. And then you also have what's called Money Strong, which I think is a great website. But your website is DiMartinoBooth.com, Money Strong, and you have a subscription service. Tell me about that.
Yes, I've been writing since the week after I left the Fed, 150 straight weeks. I recently went on a subscription service. So hop on a trial subscription. I invite you to do that. You'll get a month free of my Wednesday publications, and you'll also get a look back at 30 days at my archive. You can see what I've written about the next generation of central bankers. Believe it or not, I'm optimistic about that. And you can also see that deep dive I recently did into the restaurant industry that we just discussed.
Well, if you write the way you talk when you said, "I'll look," basically the big rollover at the Fed, they're a bunch of basically rats leaving a sinking ship, and they think there's trouble coming. For you to say that, an insider, a lot of people have said that to me. You can't quantify that until you get like an insider such as yourself saying it. But just really, really strong stuff. Again, the book is Fed Up. The writer, you see her right there, Danielle DiMartino Booth. The website, DiMartinoBooth.com, and Money Strong. You can hop on a free subscription, and you don't have to buy anything. That's fantastic. I love free stuff. I love offering people free stuff. That's fantastic. Thank you so much for coming on and giving us your appraisal of what's going on with the Federal Reserve and what's going on with this debt, and ushering a pretty severe warning. They don't really know what's going to happen. And so thank you so much for coming on USAWatchdog.com.
Thank you very much. Appreciate your time.